In the same week when US consumer prices and producer prices were surprisingly tame to some, at the end of the week it was conflict in the Middle East which reignited oil prices that may finally deliver some impact on both consumer and producer prices. With Israel striking Iran, oil prices have soared by 7 to 8% on Friday, reaching around $73 per barrel and basically up $12 from where it had been previously. As we move forward here, that increase in oil prices translating into gasoline will eventually mean that there will be an impact on consumer and producer price measures, which is one reason why, at least for Friday, the bond market sold off a little bit because the bond market said, unlike tariffs, conflict in the Middle East will have the ability to get the Fed's attention and be able to allow Fed officials to point to something that says, oh, there's the inflation that we are looking for. However, we all know that oil prices are not going to be inflationary. And like tariff prices would be and already are being in a certain way, they're going to continue to harm the economy by destroying demand. So oil prices might actually, especially given the conditions that we have here, finish off what was started by the tariff price increases. It all depends, of course, on how long this goes, how high oil prices eventually get to be. But what we've learned so far in producer and consumer prices, not just in the month of May and not just in the United States, is that the economic situation is already very fragile to begin with. Businesses are suffering, unable to pass rising costs along to their customers. And now energy prices come along on top, which is something they cannot get away from. This may actually be the straw that breaks the camel's back. Steve, Mr. Van Meter, we've been sailing along into disinflation all of the last couple of months when tariff prices were supposed to spark this inflationary acceleration, which has meant that companies were struggling. They couldn't pass along costs. And now we get an oil price spike that's, we're early in the process. We don't know how high oil is going to go, but so far it's up pretty sharply. And if it keeps going even further, it's just going to add that much more to a situation that was already pretty bad to begin with.
Yeah, Jeff, when I saw oil prices jump this morning, I immediately thought, could this be the tipping point? Because you think about every crisis, there's always something that just nudges things right over the edge. You look around at the economy right now, around the world, it's slowing down. It's been slowing down. Consumers struggling under the weight of inflation because their paychecks are shrinking. They're getting fewer hours. And everyone's expecting, although we haven't seen any really major increases due to the tariffs on prices yet, there's still the expectation that's going to happen. And right now, as you kind of said, this is a major deal because for consumers, anything that takes money out of their pocket that they can't spend on the discretionary side of the economy is going to have a massive impact. And we know that rents have been going up. We know food prices are up. And if energy prices go up, that is dangerous because if they spike enough, again, you talk about the other side of the economy, it's going to have an immediate impact. We start to look at the labor market and we continue to see signs things are weakening. Yes, Jeff, this is an absolutely bad scenario for the global economy.
Yeah, we went through this last year. We had this global inflection that showed up all over the place around March and April. We saw it in the US labor market, saw it in the economic statistics, especially for places around the rest of the world. I mean, it showed up in the marketplace. And what happened last February and March leading up to that? You had oil prices that soared. And eventually the reaction to it was initially, oh, this is going to be inflationary. If you remember, Steve and I were talking about this before we started recording, the sticky inflation crisis last year where the Fed was uncertain about what it was going to do in its policies. What ended up happening was not inflation, not sticky by any means. And instead, there was another round of demand destruction that put the global economy back on this course. As much as it was slowing down before then, the higher energy costs that showed up actually made the economy slow down even more. So depending on how this goes here today, I mean, it would have been bad enough if just the oil price action was happening on its own. But you combine that with what's happening in tariffs and the slowdown in the economy from, the payback period to begin with, you're just adding one more on top of all these other things that we've been talking about the last couple of months. It's just one thing after another, after another, after another. It doesn't add up to inflation. It adds up to the exact opposite, which is what workers are really afraid of. They can see that costs are rising, margins are being squeezed, less activity at the factory, the fax machine's not buzzing like it used to be. Now you throw some energy cost price increases on top. It's the labor market that's going to end up bearing the brunt of this.
Yeah, absolutely, Jeff, because at the producer level, as you pointed out, they're unable to pass on higher prices and they know it and they would love to. They would love to raise prices, but people can't afford it. Now they're going to be forced to absorb even more price increases due to rising energy prices. And again, where do you cut? There's only one place left. And this is what's really showing up in all those sentiment surveys. Why did we see the University of Michigan survey plunge? And it's plunged as much as it did because workers are waking up to the reality that, look, they've cut everything they can and we're next. And that's a major problem because what did we see in continued claims? They ticked up to 1.96 million. I don't know about you, Jeff. I think we get over 2 million, the thing starts to spiral out of control. But what it's clearly telling us is that employers aren't hiring and people can't find jobs. They're getting stuck on this longer. And we know that there's a relationship between continued claims and initial claims. The longer people are on it, the less money they spend in the real economy, and eventually that impacts other workers. They see their hours cut, then they find themselves on the unemployment line, and you see the two rise together. I don't know if this happens in the next week or two, but if energy prices keep going up, it's going to zap consumer budgets.
Yeah, there was almost a false sense of security after the CPI and PPI numbers came out this past week, because the CPI, was tame for the third month in a row, really the fourth month, but 3 months in a row where the CPI, especially when you exclude shelter imputations, the rest of the index, excluding shelter, was actually down on a 3 month basis, minus 0.22% on an annual basis, showing that it's not just that prices aren't increasing, they're actually kind of decreasing in a lot of different places, like airlines, which is a big one. All the airline CEOs a couple months ago said this looks like a recession to us, and their price behavior absolutely backs that up. Same thing in the PPI. The PPI barely increased in May. The core PPI was actually very small increase after a decline, a rare decline in April, which means unusual lack of price increases in the producer price level, which means that companies are taking the hit. And you throw those things together and say, okay, this is good. Everybody said that tariffs are going to raise prices, but it's not showing up in consumer prices or in the producer prices. But I think consumers and a lot of the business community understands the difference here. That's not good news, because what it means is that as costs are rising because of tariffs, businesses are not necessarily choosing to take the hit. They have no choice but to take the hit, but they're not going to do that for long. And as Steve just pointed out, we may be seeing their initial response to being forced to take the hit, which is letting more of their workers go. Of course, we had the payroll report and the labor market numbers for the month of May, which were really atrocious, especially on the household survey side. So we may already see this process beginning before we even get to now oil prices soaring on Middle East conflict.
Jeff, you made a really key point here, demand destruction. And we have to understand how is this happening is because, again, consumers are falling behind. Look at the CPI. A lot of people think, okay, we want inflation to come down. But at the same time, if it does come down, what it means is businesses have an inability to give out bigger pay raises, particularly since we already know that tariffs are a tax. So businesses can't pass it on to their workers. And what are we hearing from businesses? Yeah, we're going to give out raises, but they're getting smaller and smaller. At the same time, front-running the tariffs did not lead to hiring, led to an increase in hours. We know that's going to get reversed because we see in all of the surveys more signs that, yes, as you said, the fax machines aren't worrying here. We're seeing, of course, new orders drop. We know backlogs, which have been going on for years, are likely to come to an end and pretty soon. Workers very keen to this reality. They know it's coming, so they're worried about that. So again, all about demand destruction. Prices go up on one side, you have spending that has to come down on the other side. Next thing you know, you don't get inflation. You do get it on the energy side, but you get disinflation on other parts of the economy to offset it.
Other parts of the economy, that's the big one. I think that's where we see a lot of the more concerning notes is from the services part of the economy. Not only do we have really weak services pricing in both the producer price index and consumer price index. Recent surveys on the services economy, the ISM non-manufacturing index is a perfect example. That one fell below 50 for the month of May, which is rare for the ISM services. In fact, you don't see numbers below 50 outside of outright recession periods. So what that suggests is that, again, before we even get to this oil price spike, consumers were already forced to make choices. Their discretionary versus non-discretionary spending. Discretionary costs or just non-discretionary costs go up. they have to cut back on their discretionary spending, which tends to be on the services side. That's where you get to the airlines. Airlines and air travel is discretionary spending. So we're already seeing, before we get to this oil price spike, pulling back in consumer spending, pulling back in those areas, which really confirms the other thing, the other factors. And then you got CPI, PPI, which already show the demand destruction that's being absorbed by the business sector. And then, like I keep saying, you throw the oil price thing on top, it's just another log on the fire.
Yeah, Jeff. And then we look at the summer and like you said, people weren't going to fly as much. They said, we're going to drive and go on vacation. Well, you now know, as of right now, those plans are changing as we speak. You see it in the restaurants, and that's a big indicator. You can walk into most restaurants today without a reservation, even super busy ones that were really popular. You can walk in, and that's because demand's going down. And you're right, it hits the service sector in a major way because a lot of these people are part-time. So it's easy to cut their hours. It's easy to cut their jobs. I kind of noted here recently that many people know I'm in Orlando, which is a vacation destination of the world. Back in the boom times here, you'll talk to service workers. They'll have 1.5 jobs. They'll have their primary job, and then they'll have another one to pick up hours here or there if they need to fill in. Right now, people I'm talking to, they have 2.5 jobs because their primary job isn't enough. They have a second one. And on top of that, they're backfilling somewhere else. It's quite ridiculous, but you're seeing the pain in the services sector. And as you said, the first thing people are going to cut, services spending, and it's already at dangerous levels, likely to get worse.
Yeah, but that's the thing, right, Steve? Everybody said, for services, we're not going to fly this summer. We're going to drive. But according to the latest estimates from the Energy Information Administration, they're not doing that either. Gasoline demand, according to EIA, was well below where it had been last year, and even further below where it had been 2 years ago in 2023. Even overall petroleum demand, according to EIA numbers, was below last year at this part of in this year, this part of last year, and it was below where it had been, or roughly even where it had been 2 years ago. That's despite the fact that gasoline and oil prices are a lot lower this year already. At least they were up until this past week. Oil and energy prices were a lot lower, and yet that wasn't triggering people going out and driving and flying more. On the contrary, it was the reason why oil and gasoline prices were lower was because demand from all of these other economic problems had already been destroyed. So oil prices were moving lower and were already low because demand wasn't there. Then you raise prices. What's that going to do to demand, not just for oil and energy, but for everything else around the economy? So we already have an example of demand destruction in the energy space before we get to this latest price spike. So it's going to be services. You're going to see it in the manufacturing economy, as Steve and I have been talking about. We're starting to see some of the numbers on the payback in terms of global trade. I know the UK just reported a record drop in exports to the United States for the month, I believe it was of May. You've seen that in China. China exports to the U.S. were down by almost or around 33%, if not more than 33%, if I remember that correctly. Now, some of that was redirected to other places. Some of it was sent to third-party countries. But either way, we're getting Canada, another example. Canadian exports and imports down sharply. Canada just reported yesterday on their wholesale and manufacturing sales that were down sharply. So the manufacturing sector is already confronting a payback. The services sector is already confronting the demand destruction. And now we got oil prices that are in the short run going a lot higher. Who knows how much higher they're going to go? But if they go any higher, even just stay where they are, it's going to just be it's going to be one too many things.
Yeah, Jeff, and you see a snowballing. We heard from the Port of Los Angeles. They said, yes, shipments were down, somewhere 35%. But what's more interesting wasn't what we knew was coming, was what the response was to their workers. Because we've been hearing from businesses, hey, we're not going to lay off under no condition. But we knew what was going to happen. They're just fine. You have a job. You just don't come to work this week because I have no hours. And that's what the ports are reporting down there and say, look, we have people that are getting 0 hours. And then they start to go out and interview a lot of local businesses. And I said, look, we haven't seen demand destruction like this since the financial crisis. So again, now you tack on, like, hey, let's drive energy prices up. As you said, people all of a sudden aren't traveling for a vacation, but they have to cut their spending somewhere else. So it makes it really easy, particularly as we go into earnings season here. It'll be interesting to hear from some of these services companies. Are people going to start canceling Netflix and things like that? $20 here and there doesn't sound like much, but when you're facing rising prices, you got to start cutting anything that you can click a button and make it go away.
Yeah, it's not just that. It's also concerns about jobs, right? We keep talking about that too, which is the other side, as you just said, of all of this. The Federal Reserve Bank of New York, in their survey of consumer expectations, they keep showing the same things, which is that job finding expectations are incredibly low. Even in the month of May, despite all the positives, stock market rebound, tariff delays, and all that, the job finding expectations, according to the New York Fed, were about as low as they were during the lockdowns and the pandemic. Certainly closer to those than anything, even the late 2010s, which weren't all that great. So consumers continue to say, okay, we weren't as pessimistic as we were in April, but we're still pretty darn pessimistic. And when you throw that on top of the lack of hours, fears over job cuts, a rising cost, no wonder consumers would be pulling back, not just in what they say in these consumer surveys, but what they're actually doing. So you're getting it from all of these different sides and all these different various data points and confirming it, showing that demand destruction before we even get here was getting bigger and getting more out of control. And that's what the CPI and PPI were actually pointing to as well, is that, everything seems to be either at the limit or very close to the limit to begin with.
Jeff, and that's what makes inflation expectations interesting, because consumers continue to believe that inflation is going to surge higher. At the same time, they are clearly spending less, and they're telling people, hey, I'm cutting spending in a major way. Next week, we've got the Fed meeting. We know what Powell's going to say. He's not going to cut rates. It's not going to happen. But they're worried about tariff inflation. And now he's got something else he can worry about. That's the spike in oil prices. Now, he knows that once the conflict's over, yes, prices will come down. But he needs any excuse right now to not cut rates. But I think about this from a consumer perspective. We know rate cuts really don't have immediate impact. They really don't do anything broadly to the economy. But if they did cut and credit card interest rates dropped a little bit, it would free up a little bit of money, because on top of all this, consumer debt levels are just in the stratosphere. So you look at this from the consumer perspective. They're seeing less hours. They're seeing smaller pay raises. They're worried about losing their job. Their expenses are going up. And on top of that, their upkeep costs are not getting any relief. And so you kind of wonder, again, as I said earlier, is this the tipping point? If this thing drags on, Jeff, I really think it can be.
Yeah, I mean, there's nothing good that comes out of the scenario where oil prices go up. I mean, they actually do the job that tariffs are supposed to do. The tariffs are already doing, just not in consumer prices. But you're right, Steve. The Fed's going to look at the effect on the CPI, because they're looking at this through expectations and think, okay, there's the CPI increase that we were looking for. So if we were hawkish and cautious on prices before, now we're going to be even more hawkish and cautious on prices now. Which is exactly why the market reacted the way it did, which was that, okay, oil prices go up, which is not going to be good for the economy, but that's going to make Jay Powell less confident over his inflation theory to begin with. So in this way, oil prices end up doing what the CPI and PPI didn't do for May from tariffs. And all that does is just create more uncertainty in the marketplace, and in many ways in the real economy too. But it also doesn't matter, because all of this is just short run theater. The longer term economics, we're already seeing the results of that, and they're all adding up in the same way, which is more of the same demand destruction potential that just continues to get ratcheted up further and further as we go. In fact, that's the only thing that ever grows here is the potential for demand destruction.
Yeah, Jeff, we can go back to the financial crisis. We can look what happened with energy prices. They spiked going into it, certainly didn't make things better. It led to more demand destruction and then outright deflation. Risks here are high. I completely agree with you. Rising oil prices, absolute negative for the economy right now.